Hey, hi, good morning, everybody. Happy Monday. I hope you all had a lovely weekend. I'm sure a few people will start trickling in and joining us, but we'll try and get going swiftly as we've got a lot to get through today. So hello, my name is Lucy. I am the Policy and Research Lead at Art Fund. And before we get into the session, for anyone who needs captions today, captions are running, so you can just switch them on through the bar at the bottom of your screen. So this session has been co-funded by Art Fund with amazing support from the Going Places team from Gracie and Emma, and also through Magnet, the Museums and Galleries network of exhibition touring, with huge thanks to Dom. So we're really excited to be joined and looked after by Azets, who will be talking us through really how to make the most of using the tax relief and helping us to understand the specifics for touring exhibitions. And this is something we know is really important for us to get to grips with. We did some research at Art Fund recently, our museum directors research, and that found that only 47% of eligible museums and galleries were using the tax relief. So we know more people can be using it. And after we had the great news in the spring budget of the sunset clause being removed, hopefully that gives that extra encouragement for more of us to really get to grips with it. So the plan for this morning is that Kirsty and Scott from Azets are going to be talking us through how to use the tax relief, and we will be taking questions throughout. So if you have any questions, please do put them into the Q&A box and we can read them out as we go. And then we can have some time at the end for further discussion. So there are no silly questions. Please just do share any thoughts as we go. We want to make sure this is a really useful session for everyone. So thank you for joining us, and I'm now going to hand over to Kirsty.
Good morning. So, sorry, my video is not coming on. Oh, there it is. Great. Good morning. Hi, and I've got Scott here as well, who will speak shortly. So let's get started. So if we move on to the first slide. So we're going to cover museums and galleries exhibitions tax relief this morning, and this is a very valuable tax relief, and it's been around since 2017. But as Lucy said, we had news recently that it's now been made permanent, which is great news for everyone. And it was really introduced to encourage galleries and museums to put on more exhibitions. So the theory is that you put on an exhibition, you claim cash back, and then you're given more funding to put on more and more exhibitions. And I think the first thing to say is that I think the word tax relief is really misleading. It is a corporation tax relief. However, you do not need to be paying any tax to be able to claim the tax relief. And I think that's been one of the reasons that some people haven't claimed it. In the past, when I speak to people, they say, oh, we're not eligible, we don't pay any tax. But that's not necessarily the case. You don't have to be paying any tax. Most of you you'll be charities, and therefore you're exempt from a lot of corporation tax. That doesn't matter. You are still eligible to claim the tax relief. So if we got on to the actual specifics of it now. And as Lucy said, if you've got any questions as we go, just pop them in the chat, and we can deal with them as we go through. So the first thing to check is, as an entity, are you actually eligible to claim the tax relief? So what you need to make sure is, you can be a charitable company. So that has to be a company who's registered at Companies House. So if you don't know if you're a company or not, if you go on the Companies House website and put in the entity's name, that should tell you if you're a company or not. So for example, if you were just a charitable trust, so this is really about how you were legally set up. If you're a trust, then you will not be eligible for this relief, and that's because you are not within the charged corporation tax. So that's first thing to check. You can also be eligible if you are a wholly owned trading subsidiary of a charity. Or if you're a company that's owned by a local authority, that would also be eligible. But the key thing is that you are, as an entity, you are within the charged corporation tax, even if you are not paying any tax, which most of you won't be. And then the next point is that you would have to be a primary or secondary production company, and we'll come on to explain that in a moment because that's quite important. So once you've decided that the actual entity qualifies, you need to make sure that you actually maintain either a museum or a gallery, or that could include a library or an archive. So the relief's been set up this way because you can't just be a charity which doesn't maintain a museum or gallery and put on a one-off exhibition and claim the relief. So let's say you are a mental health charity and you didn't normally maintain a gallery or museum, you couldn't then put on an exhibition as a sort of one-off and then claim the tax relief. So this is really designed at charities that are always involved in museums and galleries. But things like the libraries can claim it, or if you hold some kind of an archive. So we claim it for the National Galleries of Scotland. They put on a number of exhibitions every year, and often when people have got an archive, it could be things like historic houses. They are putting on exhibitions or displaying objects, and they are eligible to claim as well.
Is it okay, Kirsty? Sorry to interrupt you. I'm just going to shoot in straight away whilst we're on eligibility with a question from Vincent, who was asking, are local authorities themselves eligible? Our council owns and operates the museum. And I know we're planning on doing another session in the autumn specifically for local authorities, as it's a complex case, but a few words on that would be really useful.
Yeah, no, that's very much. Yeah, and actually the reason, because I know we are going to do another session, I didn't go into it too much detail, but so basically a local authority itself is not within the charged corporation tax. It doesn't pay it. The local authorities are effectively got special exemption from tax, so they themselves don't do a tax return, and so if they are running a museum or gallery, they are not able to claim it. However, the way to go around that would be for the local authority to set up a subsidiary company and do it through that subsidiary company. So we have, for example, Glasgow Life is, well, actually it's set up as a charity, which is in Glasgow. It's effectively run by the local authority, but it's set up as a separate charity under the local authority, and it runs things like the Borough Collection, and they are able to claim it. So the actual local authority itself is not able to claim it. But there are other ways that it can be done, but it might involve setting up other entities. But as Lucy said, we are going to do a session that's going to focus a lot more on that later in the year. Hopefully that's enough on that for now. So once you've decided that you are as the entity qualifies, then what we need to look at is don't know what happened there. You need to check if you are a primary or secondary production company for the exhibition, and these terms were introduced so that where we've got exhibitions taking place at more than one venue, then both entities are able to claim on the tax relief on their own costs. And so we'll go into this in a bit more detail, because I think this is quite key for what you guys are doing in terms of kind of creating effectively collaborative exhibitions. So in this table, you can see we've got a definition of a primary production company and then the secondary production company. So there can only be one primary production company per exhibition. But there can then be lots of secondary production companies. So the sort of typical example of this is, let's say the Tate created an exhibition, and it was the one who planned it, did most of the work for it, and it would then be the primary production company. If that exhibition then decided to go on tour and it toured to the National Galleries in Scotland, then in that situation, the National Galleries in Scotland would be the secondary production company because it was receiving the exhibition. Both of the entities are able to claim on their own costs, but obviously the secondary company is likely to have a lot less costs, but it can still claim on the costs for putting it on at its venue. And I know with what you guys are doing is sometimes a bit more collaborative. I think what we have to be careful of is not to say that we've got a partnership going on. What we need to make sure is in your documentation and in the way you're arranging it, that you have actually got a primary production company. So one person that's taking the lead effectively, and then you've got a number of secondary production companies. So the primary production company, it needs to make an effective, creative, technical, and artistic contribution to the exhibition. So it has to be the entity that actually is negotiating most of the contracts and paying for the rights, the goods and services for that exhibition. And where the exhibition is held at just one venue, that would be the company that would be responsible for the producing and the running of the exhibition. So quite often you will only have one primary production company and you won't have any secondary. So, you know, there's a lot of galleries who just put on an exhibition on their own and it doesn't tour or doesn't move anywhere else. But where the exhibition is held at 2 or more venues, the company responsible for the production of the exhibition must be responsible at 1 or more of those venues. So you can't have a situation where somebody creates the exhibition, but they don't put it on at a venue. So the primary production company needs to put it on at a venue. And until April 22, it had to be the first of the venues, which actually was quite difficult because sometimes it might not have been the first of the exhibitions. So the rules were relaxed in 2022. It just needs to put it on at one of the venues.
Kirsty, can I just jump in and ask, sorry, correct me if I'm wrong, but my understanding is that there's no difference in what the primary and secondary production companies can claim in terms of the finance. So where we're working in something that is that true collaboration, it's very much sort of in name only that somebody might be the primary and somebody might be the secondary.
Yes, so the actual costs that each of the entities can claim on are exactly the same, and we'll come on to what the qualifying costs are later. But yeah, so there's no, it's just that the company can claim on the costs that they've incurred.
Thank you.
So we say so that won't make any difference. But I think for your collaborations, it'll be quite key to say that there is a sort of primary one and then there is a few secondary ones. I suppose what we don't want to get to is a situation where HMRC says there is no primary production company. And I've actually put, this is a sort of summary schedule of the legislation. I've put the legislation at the very back of these slides because I assume we'll send them out. And people can then actually read what the actual legislation says about a primary production company. And you will see that what it says is if nobody meets these conditions, then there is no primary production company. And also we don't want that because then you won't be able to claim. So it is important to state who is the primary production company and who are the secondary ones. And when you actually submit the claim to HMRC, one of the requirements is now that you actually say if you are a primary or secondary company. And if you are a secondary company, you also then need to tell them who the primary production company is. So they've just tightening up a bit on some of the details of the tax relief, and it's partly because they were receiving claims and people were basically not giving them very much information. So HMRC just didn't have enough information to check that it was correct. So there's definitely a requirement to submit a lot more now. So the final point on the primary production company is that you will be the one actively engaged in the decision making in relation to the exhibition. So that's the exhibition effectively, as a whole. Whereas for the secondary production company, it is just more actively involved with the decision making at its exhibition. So when it's put on at its venue. And I understand that because you're doing a sort of collaboratively, some of these lines might be slightly blurred. But I suppose if you've got any documentation, it would be useful to capture these points in the documentation. So if HMRC do ask the question, you can clearly say to them, this is the primary company, and this is the secondary production company. So we've just got the next slide was just a sort of diagram to show that, you know, if you had a collaboration, it might be that the Horniman created an exhibition, and it would be the first company they might put it on, and then that exhibition would then move to, say, Red House Museum, and then potentially to the Bristol Museum and Art Gallery, and all of the companies are able to claim on their costs. So there's no restriction on that at all. So once we've figured out whether you are the primary company or the secondary company, then we need to just check that the actual exhibition qualifies. So to be a qualifying exhibition, it needs to be open to the general public. And it's important that that is decided at the planning stage. So you couldn't decide later on that you were going to open it. It must be at the planning stage. And if for some reason the exhibition wasn't able to go ahead, or it wasn't able to happen because of things like COVID, then it would still qualify. We had a lot of claims during COVID where they just weren't open at all because everything was shut, but we were still able to claim on the costs. So again, what's really important is just to document everything at the beginning. There is no requirement to pay for the exhibition. So a lot of exhibitions are free to the public. So that doesn't matter for the tax relief. You can charge or not, that's not a problem. So an exhibition is defined as a curated display of collection of objects or works. So this could be, it could just be one single object, or it could be a collection of objects. And as long as they have some scientific, historic, artistic, or cultural interest, then that should qualify as an exhibition. So this could include things like an outdoor sculpture park. That would be eligible as well. The only thing to bear in mind with that is you would have to be maintaining the space which it's in. So as we said earlier, one of the conditions is that you maintain a museum. If you had outdoor sculptures, you would have to be maintaining the space which the objects are in. We had a situation once where an art gallery was trying to put objects around the city. So they were putting things under bridges and in gardens around the city, and they were trying to claim that that was an exhibition. And HMRC said because they didn't actually maintain the city, it was therefore not eligible. But just a normal standard outdoor sculpture park that you're maintaining will also qualify. So it can be a single object, doesn't need to be a collection as such, but it wouldn't be an exhibition if the actual item is subordinate to the use of the object. And the example that HMRC gave in this case is, for example, if you had a historic train that was transporting passengers, it wouldn't be enough to say that that train was the exhibition, because its actual other function is really to transport people. That doesn't, however, stop there being an exhibition on the train. So it could be that inside the train there was actually an exhibition that would qualify, but the train itself as the one item wouldn't qualify if it was transporting passengers. Whereas if you had a collection of trains that were stationary and people were not using them for transport, then that would be eligible. And then the final point is that a certain amount of the core costs that you spend need to be incurred within the UK. So until April this year, it was that 25% of the core expenditure had to be incurred in the European Economic Area, but that has changed from April, and it's now we have to spend 10% within the UK. And we'll come on to talk about what a core cost is in a minute. Generally, we don't find this to be a big problem for clients. Most of the costs that they are incurring tend to generally be in the UK. So if we move on now, there are some exhibitions that are excluded and you can't claim on. These would be an exhibition if they are part of a competition. So I know some of I think there's often I think it's a BP art competition for schools, or any kind of competition that you are putting on as an exhibition that would not be eligible. We can't also claim on costs if you are promoting or selling the items on display. So this prevents it's often some of the small local art displays which are actually selling local artists' works. They are not eligible to claim the tax relief. And the final excluded exhibition is it can't be a display of live objects. So this prevents things like the zoo saying we've got a collection of animals that have got scientific interest. That is not eligible because the animals are alive. Likewise, things like the Botanic Gardens aren't able to claim because that is a collection of live plants. The Botanic Gardens in Edinburgh does actually make claims, but it's on things like pressed flowers and things like seeds, which are not deemed to be alive.
We've had a question, but I think you've just answered that one. The live objects include plants, and it sounds like
so it depends. So actually, we had a really interesting question once from when I was doing one of these presentations about whether cut flowers are dead or alive, and HMRC said that they were dead. I'm not sure that's the scientific answer, but that's what HMRC believed to be the case. So things like the Botanic Gardens definitely claim on it, but not on the live plants, but more on related exhibitions.
Before we get into the next section, I wonder if Don wants to come in now and ask his question. He's just posted in the chat. Don, would that be easier than me reading it out?
I think someone else is signed in under my name, so it's not actually me. So I'll let them speak up if that's helpful.
Okay. Yeah. And I don't know if people who aren't panelists can read out. So is that okay, Kirsty, if I read this one now before we go into the next section? Great. Can the lead primary production company hold the funding and reimburse other organisations who are co-curating an exhibition for the expenditure? We will be in this situation, but cannot contract for goods and services for another organisation. We thought that they could invoice us for the costs and provide evidence of the spend to be claimed. Question.
Yeah, so as long as the company, so basically you can only claim if you have actually incurred the costs. So if somebody else is like say another art gallery is providing you with services or restoration works, as long as they've invoiced you and as long as you actually pay for that service, then you would be able to claim the tax relief on those costs. And as long as the payment's made within 4 months of the year end, then you should be able to claim on that. I'm not quite sure if that was definitely the question. I'm not sure if it actually answered the question. I don't know if I've covered that or not.
Yeah, and I'm not sure if other people can unmute, so feel free to if you can, or if not, pop something else in the chat.
We've just got another question in there as well about the sale of goods, which is relating to, I'll read it out. So if an exhibition about traditional craft, which includes historic objects, but also features current craft makers and their work is for sale or promoted in the gift shop alongside that exhibition, would this disqualify their exhibition from being?
Yeah, no, so as long as if you're selling things in the gift shop, then that's totally fine. It's more that you can't have things for sale in the actual exhibition.
Thank you.
So I don't know if that other point was covered. Okay, here we go.
Yep, so Anne's coming back to the previous question, does that mean that Magnet/Horniman would be the primary producer for all of our touring exhibition projects?
So if they are the ones who are effectively taking the lead and making the initial decisions about how it's all going to work, then they are likely to be the primary production company. And then if the exhibition then moves on to other galleries, then they would be the secondary companies.
Yeah, I can just jump in there. As Horniman aren't involved in the touring exhibitions, they wouldn't be classed as the primary production company. So, and it would be National Museums, Liverpool, Sheffield Museums, and Manchester Museum in the Magnet example.
Okay, so the Horniman is not part of. So they're not the one who's actually the lead.
So Horniman have received the grant funding from the funders, but they won't be the ones leading on each of the touring exhibitions there.
Okay.
Thank you. And just one more question before we move on from Julie. Would a charity be eligible if the museum is owned by the local authority, but the charity was caretaker or wholly maintained and run by the charity?
Yes, it should be. That should still be eligible if the if you've got a charity that's owned by the local authority. I mentioned earlier, Glasgow Life. They are a charity, and they are effectively owned by the local authority, run by the local authority, and they claim on a number of exhibitions every year. So that might be worth even just having a look at their accounts. You should be able to see that in there as a comparison. Okay. So if we move on, if we've got no more questions at the moment. So this schedule just shows the rates of repayment for the tax relief. So until 27th of October 2021, we were getting a rate of 20% for a non-touring exhibition and 25% for a touring exhibition. In addition to that, there is actually a cap on the amount of repayment that you can receive, and this is £80,000 for a non-touring exhibition and 100 for a touring exhibition. Now, this is per exhibition, so it's not per year, so if you've got an exhibition that runs over a couple of years and we're claiming costs in numerous periods, this cap is the total cap for that. But what's therefore you should think about is, if you are kind of thinking you might breach these costs, is have you actually only got one exhibition, or do you have more than one exhibition? And really, I suppose that's a matter of just looking at the facts, and it might be that the way it's portrayed to the public on your website. So, you know, if on the website it really looks like it's just one exhibition, it would be very difficult then to go to HMRC and say, actually, you've got two exhibitions. But so this is definitely something to consider right at the beginning when you are doing your planning for this. And then from the 27th of October 21, the rates increased. So we've now got a non-touring rate of 45% and a touring rate of 50%. Now, this was supposed to be a temporary increase in the rates after COVID. However, HMRC have now made these permanent, which is great news. Basically, people are getting at least double back that they were before. However, what they haven't changed is the caps on the amounts of repayments. So we've still got only £80,000 for a non-touring exhibition and 100,000 for a touring exhibition. So in some ways, it tends to be the larger exhibitions that are and the larger museums and galleries which were breaching these caps anyway. So this, because they haven't increased the caps, is actually helping the smaller ones because they are now getting double the amount back on that. So it's really a really valuable relief for them. And then when we talk about what is touring and what is non-touring, there is a couple of conditions that we need to meet. So you'll get this extra higher rate if when you're touring, if the exhibition goes to 2 or more venues. We also need to meet the condition that 25% of the exhibition at the first venue will need to then appear at each subsequent venue. So this gives a little bit of scope to change some of the items and the objects, to maybe sort of personalize them to the gallery that receives them, but it's designed not to totally change the exhibition. And then the deinstallation at the first venue and the installation at the second venue mustn't exceed a period of 6 months. So this is just to ensure that there's not huge gaps between the exhibition. So if you didn't meet this condition, then HMRC would effectively say that you can still claim the costs, but it wouldn't be a touring exhibition, it would just be a non-touring exhibition. And then there has to be the intention that you're going to tour at the outset. So again, sometimes we find that people create an exhibition and it was not planned to be touring, and then it does really well, so they decide then to tour it. There has to be an intention at the outset for it to tour. And again, these points were really important during COVID, because people had planned to tour exhibitions, but then they weren't able to happen because of COVID, but we were still able to claim on them at the higher touring rates. And the final point is that the primary production company must be within the charge to corporation tax to be able to claim this. And this is really, I guess, to prevent, say, you've got an overseas entity who wouldn't be within the charge to corporation tax. If it created an exhibition and then brought it to the UK and toured it, it wouldn't qualify for these rates, because it wouldn't be within the charge to corporation tax. I think have we got
hopping in with another order question from Karen, who's asking, are staff costs for working on the exhibition eligible?
Yes, they are, and we'll come on to that in just a moment. Actually, I'm going to go all through the cost in a minute. Have we got any more questions? Actually, I've seen everything pinging.
I think that is all of them. We were just sorting out.
No, there's another question. So I'm getting my camera on from the chat from Sarah Roper at University of Manchester. Is it correct that only the primary production company can only claim the touring rate?
No, it should be that anybody, if we decide that it's a touring exhibition, then you should be able to, somebody receiving it should be able to claim on the high rate on their costs. Okay, so we're now going to go on to looking a bit more about how we actually calculate it. And in this section, I'll talk about the qualifying costs. But before I talk about the qualifying cost, I just wanted to sort of explain how HMRC view an exhibition in terms of its different stages. So they see that there is four phases of an exhibition. The first part is a speculative phase, where you are deciding whether you're going to go ahead with an exhibition or not. And that is deemed to be not a core cost. Once you've decided that you are definitely going to go ahead with a particular exhibition, then we move into this producing phase. And this is seen by HMRC as a core cost. So this is the time from deciding that you've given it effectively the green light. HMRC talk about the green light, and that's really just the date you decided you were definitely going to go ahead with the exhibition. Quite often, some small galleries might have just, there might be two people who make the decision that it's going to go ahead. Whereas larger galleries might have a more formal process to approve an exhibition going ahead, or it might be just that you need to wait until you've actually got the funding and the budget agreed for that. So whatever the internal decision-making process is, it's quite good to document that, so that, because one of the things we now need to show HMRC is what date did you start producing. So I would document that somewhere in your information, so we can include it in the claim. So in this producing phase, that is basically all the costs that you incur from giving it the green light right through to the opening of the exhibition. And the date the exhibition opens to the public is effectively, we are moving into this running phase. That is not a core cost for the purposes of the tax relief, but it's still important that we record costs during that phase. And then once the exhibition is finished, we move into the deinstallation or closing down phase. And if the exhibition was open for less than a 12-month period, that deinstallation phase is also treated as a core cost. We've got some more questions.
Another question in the chat, which I think I know the answer to, but I kind of let it come from the the horse's mouth as such. If one of the venues that the exhibition tours to isn't eligible, does this exclude everybody else from claiming?
No, it shouldn't do. It shouldn't. It shouldn't mean that. I'm just trying to think why they wouldn't be eligible. But I suppose they might not be eligible because they are, say, an unincorporated trust, charitable trust, rather than a company. So it shouldn't preclude everybody else from claiming.
Thank you.
So we've got these 4 phases. So what we need to do is now look at the actual costs and what costs are eligible. And because we have got these different phases, we quite often do a lot of apportionment of costs. So we talked about staff costs. So you might have a curator, who's full-time employed, and therefore you will have costs in all these different phases for that individual. And so what we would need to do is apportion their time between the different phases. Likewise, with things like insurance costs or heat and light, again, we need to apportion the costs between the different phases. So, so we also need to look at the income from the exhibition, and the income that you need to include in the calculation is the tickets that you sell. If you sell tickets, again, we don't need to sell tickets. But if you do, we need to include the income from that. Any royalties or rights that you're receiving. If you receive any grants, we would include those, but we only include a grant if it is specific to the exhibition. So a lot of you will receive general grants just for the charity. We don't need to include those unless it's a grant that says, I'm giving you this grant to put on that particular exhibition. If you are selling any merchandise that relates to the exhibition, we would include that, but only if that income is in the charity. So quite often, particularly when people have got charity shops, they will set up a trading subsidiary, and therefore often the merchandising income will be actually in a different entity, such as the trading subsidiary. If that is the case, then you don't need to include the sales of these merchandise in the calculation. Now, if we move on to talking about a bit more about these core costs. So as we said, we've got these 4 phases, and we need to work out all the costs that relate to the exhibition and then apportion them into these different phases. So the typical costs are things like curator and research costs. So you might have a full-time curator employed, but you might also have research assistants. You will have other staff time as well involved in the actual creation of the exhibition, even down to somebody in the finance team who's doing the budgeting for that particular exhibition. So basically any staff costs, anybody involved, we can take a proportion of their salary and include them. Likewise, if you've had to pay somebody external, then you can include that time as well. We can claim on the exhibition installation costs. So that could be, it could be hanging pictures, it could be moving objects. Whatever the costs are in actually the installation, we are able to claim those as a core costs. We can also claim on any loan costs. So you may be borrowing items from other galleries. You can claim on the cost of doing that. And often with that, there's things like insurance and transportation costs. Again, we are able to claim on that. And it might be that you've got some costs of insurance, which is actually for covering all the periods that we discussed on the diagram. And again, you would just need to apportion them between the different sections. If you've got any digital spend, we would need to include the cost of that. And then sort of specific venue costs. So just the setup and any equipment hire that you need. It might be that you need specialist lighting or special dehumidifying machines for, say, a particular piece of painting. We could include the costs of that. And then finally, often charities will have an element of irrecoverable VAT, and quite often we see that it just gets sort of lumped together in a big pot. But we can include the cost of that, because that is a cost of the entity, and it would therefore be a matter of spreading that cost between, actually allocating it out to your different costs. No more questions on that at the moment?
Thank you, Kirsty. Yep, there's a few that have come in. So Helen has asked, currently we don't create many touring exhibitions, but we do buy in touring exhibitions from companies and other museums. Would these be eligible? Would the originator of the exhibition had to have claimed in the first place?
So if you buy in and the originator is not let's say they were outside the UK, then you wouldn't be able to claim on the touring rate on these, because one of the conditions, if I jump back to the slides, one of the conditions, oh, there we go, sorry, I've gone too far. So one of the conditions for the touring rate is that the primary production company would need to be in the charge of corporation tax. And I think what we're saying here is that maybe that is not the case with this this entity that created the exhibition, from what you said. But it might be that you can still claim on your costs. So if you've basically just bought in an exhibition and you've actually put in some artistic, and input into it, then you might still be able to claim on it as an exhibition where you are the primary production company. I think it depends whether you've just bought something that's totally already made or whether you've actually had some input in deciding. It's whether we can meet that definition of primary production company. So just to
check, if we've bought it in from within the UK,
yeah, can
we claim as standard as a secondary production company?
Yeah, it would depend if so you're saying a situation where the person who's created it has made a claim or not.
Does a primary production company need to have made a claim?
They don't have to necessarily need to have made a claim, but I guess they would have to be eligible to be the primary production company in the first place.
Say, for example, I'm an organisation and I buy in a touring exhibition from another larger UK organisation.
Yeah. Yes. So that would normally qualify. And chances are in that they would normally have claimed. They would normally have claimed on that. In most cases, I think it would be. I'm trying to think of an example where that might not have been the case and why they wouldn't have claimed on it, because normally what we see is that it tends to be often the bigger galleries that kind of create an exhibition, and then we see it again when it goes into the smaller ones, or even part of it. We had a situation where it was the National Galleries in Scotland who actually put the Monarch of the Glen painting in a van and toured it around Scotland in a van. And they wanted it to be accessible to as many people as possible. So it went to schools, it went to libraries around the country, and that was claimed as a touring exhibition. That's probably slightly unusual, but I think normally the person that creates it, if it is in the UK, they would normally have claimed the tax relief first.
But then if we receive it, we can also claim our portion.
Yes, you can also claim on your costs, and your costs are probably likely to be slightly less because they've done a lot of the work up front, but you will still have, you'll still have your own creative time and your own, need for insurance and your own heat and light and all your own costs, and you can claim on those.
Thank you.
I've spotted one more question come into Q&A, and I think I'll pass back to Gracie, who's monitoring the chat. So there's a question from Jim, who was asked, what is classed as irrecoverable VAT?
What is classed as irrecoverable VAT? Right, and we will leave that until later on, and I'll let Scott, my colleague, we're going to do just one slide on VAT later on, and I'll maybe wait till the end and let him talk about what is irrecoverable VAT. if that's okay.
We've just got one other question from the chat asking about how we define merchandise, and like on that income, you know, it would be a lot of work to break down which merchandise was related to an exhibition and which wasn't, if we were looking at that from shop sales.
Okay, what you'll probably find is that when we do a lot of these claims, we come into the calculation in a minute, but what we find is that actually, unless you've got a lot of income and you're making a lot of a profit on an exhibition, then it's not going to have an impact on the actual amount you get back. So what you might do is, even if you over-egged the costs from the merchandise and included that, I doubt it will actually have an impact on the amount you get back. So it might just be that, you know, you take an estimate of it. And as long as it's kind of sensible and a sort of just and reasonable estimate, then HMRC are normally happy to accept that. It's like with a lot of the costs, there's no kind of exact science for how we have to break them up and how we apportion them between the different phases, and they just want this all done on a sort of just and reasonable basis. So again, with income, I think that would be an acceptable method. But as you say, when I come into the calculation, unless you're making big profits, which nobody tends to be making big profits on these, so it probably wouldn't matter if if you're a bit unsure and you just put in a slightly larger figure than just to be on the kind of cautious side. So now, if we move on to sort of non-core costs, so these are costs that we don't get the extra tax relief on. So it would be the general running costs. So when the exhibition is open to the actual general public, we need to record that cost, but we can't claim the extra tax relief on that. We also can't claim on financing costs, so any kind of borrowing costs, any marketing costs. Unfortunately, everyone always kind of groans when I say that, because I think that can often be quite a big element. Unfortunately, we can't claim on that. If you actually buy the exhibits, will you not be able to claim on the cost of that? So you can claim on the borrowing costs, sort of loan costs, but not if you're actually buying items. Storage costs are not an eligible cost unless it's a touring exhibition. So if you just got a standalone exhibition, we can't claim any storage, but if it's touring, we can claim it, but we can only claim for a maximum period of storage of four months. And this must be at an off-site venue. We also can't claim on legal and accountancy fees. And then if there's any sort of infrastructure costs, and this area gets slightly grey. So sometimes you've got a situation where a museum or gallery is doing a full kind of refurbishment. The actual infrastructure costs that do not relate solely to the exhibition can't be claimed on. So if you're doing let's say you're repairing the roof of the gallery, that doesn't relate just to the exhibition, so therefore we wouldn't be able to claim on those costs. When you get much closer to the putting on the exhibition, you might do things like paint the walls of the gallery. Things like that would qualify because that is likely to be painted so it complements the exhibition. Or if you're needing to buy things like special cabinets to display items in, those type of costs qualify, but big infrastructure costs relating to the actual building wouldn't qualify. And then if the deinstallation of the exhibition is more than 12 months after the start of it, then we're not able to claim on that deinstallation cost phase. And the final point is that we can't claim if there's anything that relates to a live performance. So sometimes I know we can't claim on sort of things like live animals, live plants in a way, but if you had an art gallery and there was an exhibition of paintings and there happened to be some small element of a live performance like a dance or something, that doesn't necessarily mean that the whole exhibition doesn't qualify, as long as the focus is the paintings, but we wouldn't be able to then claim on that cost of, say, those dancers in the exhibition. You've got some more questions?
Yes, another one from Helen. So thank you, Gracie, for the way you explained that last question, and also to ask about backdating claims. So she said, do you need to submit a claim before the initial planning stages or not, as they've created some exhibitions recently that they now think would have been eligible?
Okay, no, so the claim gets submitted as a part of the annual corporation tax return. And as a charity, you may not be doing a tax return every year. You may never have done one, but to be able to claim this, you need to do a corporation tax return with the charity pages. Now, these are due to be submitted to HMRC 12 months after the end of your accounting period. So let's say you've got a 31st of March 23 year end. You have then got until 31st of March 24 to submit that tax return. But you've also then got 12 months after that to amend it. So you have until 31st of March 25 to make an amendment to that tax return. So as long as the costs have fallen into a period like that, then we should be able to claim them. So effectively 2 years after the end of your accounting period, you can do that. And sometimes costs straddle accounting periods. So what we do is we claim the costs in the accounting period in which they relate. So it might be that you start preparing an exhibition and you claim a bit of cost in 1 year, and then the following year you claim a bit more of the costs. So that's the statutory deadline for the claims. So technically, if you submitted anything that was older than that, HMRC could reject it. However, we have had some success with submitting older claims. We had a client recently who submitted sort of 5 years all at once, going back to 2018. The problem is HMRC won't tell us in advance whether they'll accept it. So you have that sort of slight risk of whether you prepare all the information, spend all the time doing that and submit it, just in the hope that they accept it. But they are generally being relatively lenient because they're really trying to encourage people to make the claim. So if you're thinking it's not going to be too much work, then it's definitely worth going back and trying to do this. Particularly if you've never made a claim, I think they're more likely to sort of realize that you just maybe didn't know about this tax relief and therefore accept them.
We've got 2 more quick questions that come through. One, thinking about exhibition acquisition costs and how that relates to new work that might be commissioned to go into an exhibition.
Okay, so if you've actually paid to commission something, if you're going to own the art at the end of it, then you wouldn't be able to claim on that cost. So if you actually effectively be buying it, sometimes we see people paying an artist, but to do something, but then the artist still owns the work at the end of it, and therefore we would effectively say, well, that's you haven't really bought it, you've just you're borrowing it effectively for that period, and we would then claim on that cost.
So then that would sort of be a fee for the borrowing of it, as opposed to
and again, it's sometimes it's therefore knowing that in advance that can be sort of put in the contract and worded appropriately.
Yeah. And then another question around would an artist creating work in a gallery be seen as a live performance?
I see what you mean. Probably. So probably we wouldn't be able to claim. So as long as that's not the main focus of the exhibition, then the actual exhibition probably should qualify. So let's say there was lots of paintings by this artist, and then the artist was also there. As long as the main focus is the actual paintings on the walls and not the individual sat there, then the exhibition should qualify. But then if you've paid the artist to be there, we wouldn't be able to claim on their time. Does that make sense?
Thank you.
Great. So just a quick point on the expenditure. So to be a qualifying expenditure, it has to be you have to pay the expenditure within 4 months of the end of the accounting period, and that's really just to stop people kind of accruing lots of cost into their accounts and enhancing claims for costs that they might not be paying for a number of months or years. So that's something we need to check and confirm before including them. And then I don't want to spend too long on this point, but this slide explains what is a UK cost or a European Economic Area cost. So this rule, as we mentioned, changed earlier in this year, and so we basically now have to have 10% of the costs must be used or consumed in the UK. And in the past, before, when we were looking at 25% of the European Economic Area costs, the rules were slightly different in terms of how we interpreted it. It used to be based on, where the goods came from. So if you bought goods from America, they would be deemed to be not European and therefore not necessarily eligible. But the way it's going to work now is that the goods have to be used or consumed in the UK. So we could have a situation where we bought some items in Chile, but because they are being used in the gallery and in the exhibition here, therefore they will be UK cost and be eligible. We don't, again, it doesn't really find this to be a problem in terms of these percentages, because it does allow you to spend costs overseas, and as long as most of them are here in the UK, then it should still be an eligible claim. So if we now go on to the complicated part and how we actually calculate the tax relief. So basically what you need to do is, and we'll come on to a live example in a moment, but what we need to work out what the profit or loss is for the exhibition trade. So that basically means we bring in all the income that we've discussed. So the ticket sales, any specific grants, any merchandise sales, any rights or royalty income. So bring all the income in, and then we need to bring in the income for all the costs for the four periods. So that's our speculative period, our running period, and the production and the close down. So bring in all the costs, and then we work out whether we've got a profit or loss. And then from that, we deduct the museums and galleries tax relief part. And that is basically either it's the lower of 80% of the core costs, or if lower, the UK core expenditure. And then from that, we will work out whether we've got a profit or loss remaining. And where we've got a loss remaining, we can surrender. It's the enhanced amount we surrender to HMRC in exchange for a cash repayment. But I think if we actually go on to a proper example now. So in this diagram at the top, you can see I've split the costs into the 4 different phases. So we've got a speculative phase costing 1,000. The core producing phase is 15,000. The running phase is 3, and then the deinstallation is 6. So what we're going to do here is we're going to say our income is 20,000. So that's our, say, ticket sales. And then the costs for those 4 periods is 25,000 when we add them all up. So overall, we've made a loss of £5,000. And then this next bit is the museum's calculation. So what we are doing here is we are looking at just the core costs. So these are the costs in these blue boxes. So they total 21,000. And what we do is we take 80% of that. Now that 80% is just the figure that the legislation gives us. So we deduct 80% of the 21,000. So that figure is 16,800. So we've got a loss of 5,000, and then we deduct the 16,800. So we've now got a pre-tax loss of 21,800. And what we want to do is we surrender the enhancement to HMRC. So that's the 16,800. And we are able to surrender the full amount because our loss, which is the 21,000, is larger than that figure. So we were able to surrender the 16,800. We're saying this is a non-touring exhibition, so that would be at a rate of 45%, and therefore we would get a cash repayment on this exhibition of 7,560. If you've got a situation where we have actually got a profit and not a loss, then the amount that we are able to surrender is therefore restricted. So if I jump on to the next slide, then we will show you exactly the same costs, but we've got a larger income. So in this example here, the costs are the same, but our income is actually now £40,000, and we're saying that this was actually a profitable exhibition. So the enhancement calculation is exactly the same, but we've only got a loss now of 1,800, and that's because we've got a profit of 15,000 and we deduct 16,800. So we have got we've got the loss of 1,800, and we're therefore only able to surrender that amount. So in this example, we can only surrender 1,800 at 45%. So we would get a cash repayment of £810. So you can see that when you've got an exhibition that's profitable, then the amount you can claim back is restricted. But in reality, I very rarely see an exhibition that that is profitable. They tend to be loss-making. So as we were saying earlier, somebody was asking about whether we should include how much merchandise income we can include. Probably if you do the calculation, you'll find that even if you included a chunk of merchandising cost, it's unlikely to restrict the repayment.
We've got a couple of other questions on eligible costs, just quickly, if that's all right.
Sure.
One around the does used and consumed in the UK include the cost of getting items in and out of the UK? For example, if you're having an item travel overseas to come into your exhibition.
So this can get a bit complicated. So HMRC say we should take apportionments of things. So if when we used to have things like, let's say we're traveling over land, they would actually say we should, let's say you've got something coming all the way from China and it was traveling over land, they'd actually say we should try to apportion the costs between the different areas, which is quite difficult. With flights, they used to say that we should just base it on where the flights are booked. So this is a bit of a grey area. So it's just coming up with some sort of sensible decision. Or, if we knew exactly what the specific conditions are on this question, then we could, think about it a bit more. But I'm happy for people to get in touch with me after this, and if they've got a specific question like that, then we can go through it.
Thank you so much. And then just another query around donations from visitors and whether that is classed as an income stream.
So donations will be if it was, so let's say you had a one-off big donation and somebody said, I'm donating for that particular exhibition, that would be included. But again, it has to be specific to the exhibition. So, if you've got people who are just making general donations when they come in, then you wouldn't need to include those.
So anyone who's you've got a donations box and people are tapping money in,
that shouldn't need to be included. It would be more if somebody made if they said this has to be what they want this to be used for, that particular exhibition, then you would have to include that. But that generally doesn't really happen. So it's unlikely that you would need to include.
Perfect. Thank you very much.
Right. Okay. So I know we're slightly short on time, I think, aren't we? But so what you need to do to make the claim is, you need to submit a full corporation tax return, which is called a CT600 to HMRC. And with that, there'll be at the back of it as what are called the charity pages, and that just states effectively the income and expenditure and assets of the charity. You will also need to submit with that your annual accounts and a corporation tax return, which a computation which shows the calculation of the museums and galleries tax relief. In the past, people were not really providing HMRC with enough information, so we are now needing to identify the core expenditure, and then also what expenditure is either European Economic Area or UK costs. You need to say if the exhibition's touring or if it's not. We need to provide things like the name of the exhibition, the date the production phase began. So they are really asking for a lot more information than they ever used to. And since April, we've also got this extra information form that needs to be completed, and this needs to be submitted to HMRC before you submit the tax return. And if you don't submit it before the tax return is submitted, then they'll effectively just ignore the claim, and you'll need to go back and resubmit everything. So this is there's an online form, and it will go through, and it's basically just making sure that you're actually eligible. So we'll ask numerous conditions, and again ask for things like the name of the exhibition, whether it's touring or non-touring, who is the primary production company, who's the secondary production company. So you do need a lot of information to submit a claim. But if you're dealing with an advisor who does this all the time, then it should be relatively straightforward, and they'll keep you on track with this. So just as a quick summary, and then we're going to do a very brief slide on the VAT. Check that your actual entity qualifies. So you're a charitable company. Check that the actual exhibition itself qualifies. So remember, no competition, no live, a collection of live animals or competitions. Then the next thing to do is to record your income, expenditure, and your core costs. So this is often a bit of a collaboration between both the finance team, but you also need obviously a lot of input from people like your curators, people that are actually doing the exhibition, to help work out how much of their time has been spent in the different areas. And then finally submit the claim and get the cash back from HMRC. It is a very, very valuable tax relief, and it normally takes, I would say, about 8 weeks to get a repayment back from HMRC. And they normally, touch wood, they repay it without asking lots of questions, as long as you've set it out clearly and you've provided them with sufficient information. And then we've just got one final slide, which is going to hand over to my colleague Scott to talk about the VAT, and he will cover this point on what is irrecoverable VAT for the purposes of these claims. Before I do that, I just want to jump on at the back of these slides. I've put in the actual wording of the legislation, and this shows what is a primary production company. And I just think, because I know you guys are sort of working on potentially documents and things, it's quite useful for you to see the actual legislation. But I'll hand over to Scott, let you talk about that. But if people have any questions after this, feel free to get in touch with me. I'm always happy to have a chat with people. Thanks.
Hello, everyone. Apologies for the technological, I suppose, basics here. But moving on to VAT, there's two key points as far as VAT is concerned. One does involve recovering VAT, so I'll come on to that just in a minute. But the first point is, the first key point to be aware of is who's going to account for the income that you receive from the public, basically through admissions. Now, the understanding is that, and our thought is that, it will be individual entities that operate the actual events. So if it is those individual entities, it'll be the entity that's raising the charges on the public that will have to account for VAT accordingly. If you set up a kind of a partnership or some sort of corporate body that's going to run this, which I think is probably unlikely, but if you did, it would be that separate entity that you'd have to consider from a VAT point of view, but that would create additional MGETR problems. So the question is, will VAT be charged on admission income? Now, that will depend on the type of organisation you are and your VAT status. Some organisations are what they call culturally exempt, and in those cases the income that they receive from admissions would be exempt from VAT. Others are not, and if you're not culturally exempt, the income that you generate from your admissions would be VATable. That then determines whether or not you can recover VAT or not. Just on the income side of things, the admission side of things, remember, if you're offering an annual pass, or if you ask for people to give you donations over and above the standard admission charge, you may be able to claim gift aid on top of all the other things you can claim as well. Moving on to the expenditure side. So the first question is, and the question that was asked already, can VAT on the expenditure be recovered? Yes, it can, as long as you're charging and accounting for VAT on the admission charges. If you're doing that, then you should be able to recover all the VAT, probably in full. If you aren't charging VAT on your admission charges, then chances are it's exempt income and you would not be able to recover your VAT. The only other thing to look out for is if you do offer free of charge activities or kind of services within the admission, it may be that you've got to make some sort of apportionment, but the standard position is if you charge VAT on the income, you will be able to recover all the VAT. The VAT that you cannot claim, the VAT that isn't recoverable, can be added to the claim that you make and can be added in as a core cost according to the expenditure that Kirsty's just mentioned. The only other thing I would mention is be aware of year-end VAT adjustments. They often take effect at the end of the year, and it may mean that where there's a mixed use expense, you have to apportion some of the VAT in a slightly different way. I would also flag up reverse charges on overseas expenses. So where you receive expenses or services from overseas, you won't or you shouldn't incur VAT on them. If you do, ask the question, why is VAT being incurred? And normally you would apply, or you should apply, a reverse charge to the overseas expenses, which adds to the VAT position. If you're not registered for VAT, that expenditure also counts towards your VATable income for the purposes of registration. The only other thing I'd like to mention is where you've got inter-company charges, so where you've got 2 or 3 organisations coming together, as we're talking about here, and they pass charges between each other, those need to be recorded and accounted for from a VAT point of view. So if you are VAT registered, think about the VAT position of those intercompany or inter-organisation charges. Also remember that even if you're not paying for it in cash, if there is some sort of in-kind arrangement or a barter arrangement, VAT will still be applicable and VAT still needs to be recorded and accounted for. And finally, where the exhibition is being moved overseas, that would effectively be seen as an export if it's going outside the UK to somewhere else. Remember, there's customs duty and VAT issues associated with imports and exports, another issue for you to think about. That's all I was going to cover on the VAT side of things. But as I say, the main issue is account for VAT correctly on the income. That then dictates what element of VAT you can recover, which then fuels or dictates how much of the expenditure you should put into the MGETR claim. Okay, that was me. I'll pass back to Kirsty, I think, and we'll kind of work out what we're doing next.
Thank you so much. That was really, really helpful.
Well, that's us, unless anybody's got any more questions.
That's wonderful. Thank you so much. I think we've worked through a huge number of questions. Thank you so much, everybody, for sending in such useful questions for us to talk about. And just a reminder that in due course, Art Fund, along with AZETS, will be collaborating on a workshop as well, really specifically looking at how this can work for local authorities. So do keep an eye out for us sharing those details. Just a couple of things coming through in the chat now. Yes, we will be sharing the slides and also the video of this workshop. We'll also be putting together sort of a bit of a fact sheet there as well that will reflect some of the queries and questions that have come in from you guys across the workshop too. So I think really it's just for me to say a huge thank you to Kirsty and Scott for sharing their absolutely fantastic knowledge with us today and for taking us through in such a high level of detail. And thank you so much, everybody, for joining us and for sending in such useful and really, practical questions for us to be considering when we're thinking about this. And as has been mentioned many times, please do, get in touch if you've got any more queries, and hopefully we can work towards absolutely everybody being able to make use of this fantastic opportunity to get that that tax reclaimed. So huge thanks everybody, and yeah, thank you so much for joining us.
Right, I think we've got